Hi there, clients and friends. Mike Brady here with Generosity Wealth Management, a comprehensive, full-service wealth management firm headquartered right here in Boulder, Colorado. And today is going to be a little bit longer video than is normal. This is the third quarter review, fourth quarter preview. We've got about 2.5 months left. You're hearing all kinds of news, both on TV, radio, in print, and I want to kind of debunk some of the things that you're going to be hearing about. Because it's a long one, and this is actually going to be a little bit more technical, and I might go a little bit faster just because I have so much to cover. I'm going to give you all of my conclusions right up front. So if you want to turn my video off in the next 30 to 60 seconds, you can. Right off the bat, I'm not freaked out, as in we're in the just about to go off this huge cliff in a week or even 2 or 3 weeks due to anything that the Congress is doing. There is a momentum that is being built up on the private sector with available cash that we are going to, I believe, from an investment point of view, come through this fine. It is not unusual for us to have various conflicts, whether or not it's an international conflict, whether or not it's our own Congress and the president having a dispute, and so I am not freaked out. I'm going to debunk here in today's video some things that you might hear from an investment point of view, and then I'm going to try to prove them as things go on. But here's my summary, is that rising yields does not necessarily mean that the markets are going to go down, okay, and the bond markets in particular. The economy, if the economy goes down or slows due to anything that the federal government might do, that does not mean that our markets are going to go down. So the economy does not equate to the markets. And if you've felt that the last 3, 4, 5 years the unmanaged stock market indexes have done very well, but yet the market is, but the economy is muddled through, then that's just one proof, and I'm going to give a few other proofs of that as well. PE ratios are not everything. Consumer confidence is pretty much meaningless in my opinion. Warren Buffett is not infallible. He's out there talking about certain things, and sometimes I disagree with him. I think he's a brilliant individual, but you know what? That doesn't mean that he's God and that everything he says we have to take as God's word. I do believe that the increase in the U.S. debt as it relates to as a percentage of our national GDP over the long term does provide a headwind that will dampen some of the opportunities that we have in the investing community. And so that is something that I think long term, but it doesn't mean that it happens next week, doesn't mean it happens next month. Time is your friend, and that declines are normal. If you have been watching my videos, if you are one of my clients, hopefully that you have a portfolio of stocks, bonds, and cash. Sometimes the stocks do well, sometimes the bonds do well. They kind of mesh together. You might have some satellite holdings as well. Stick true to what is the investment strategy for you so that you can sleep well at night, and understand that everything that you hear on TV and the news is not necessarily the truth, and that, in my opinion, the sky is not falling no matter what they want you all to believe. So if you want to turn off the video, that's fine, but now I'm going to talk about it a little bit more in depth with lots of graphs to prove, I don't know about prove, but to give some analysis to you about why I've come to the conclusions that I have. And my clients expect me to give them straight answers. And if I don't know, you know what? I tell them I don't know. The market has a tendency to go up. Sometimes it goes down. Sometimes it consolidates. Up, down, sideways. That's only 3 ways that it can go. Up on the screen right now, you're going to see it for the last 112 years. You're going to see times when it has consolidated. You can see times when it has advanced. At times it has declined, but it has recovered. Time is definitely your favor as an investor. And one thing you have to ask yourself is, are you an investor or are you a speculator? And time is something that hopefully that we all have, even if you're going to retire next year, even if you just retired or in the middle of retirement. Hopefully you've got a long life expectancy, and so outliving your money is one of your goals, but also possibly grabbing income from it. One thing as you look at that graph right there is you're going to see the last 12, 13 years. And so the question is that a consolidation, or are we about to take off into one of those advances? nobody knows 100% for sure, but I am more in the optimistic mode than I am in the let's jump off the ledge and everything is going to be horrible. Here it is over the last 13 years or so. You're going to see up, down, etc. That last little bit since about March of 2009, I think we all know that that friend, perhaps you were it, who said, oh my gosh, the market can't continue to go up. It can't continue to go up as it goes through. The Dow went through 10,000, 11,000, 12,000, 13,000, 14,000, etc. And sometimes it would go back down. And that person would say, oh, see, I told you that it was going to go down. Well, you know what? This is the same person who might have been in cash the entire time and missed the up and the down. And so declines are a part of it. The market, as I mentioned, goes up, down, and sideways. And so you've got to be willing to take all three of those, and you can't expect for it always, at all times, to go just straight up. The economy does not necessarily mean that the market will do the same thing, that they correlate, go in the same movement. So if what happens with the debt level, the debt ceiling, slows down the economy in some way, which I don't know that that's going to happen. There's certainly a lot of pundits out there who seem to know exactly what's going to happen, either on the left hand or the right hand, what's going to happen. I don't know. I just admit that. But here, up on that graph on the sheet there, you're going to see, as an example of what I've just said, unmanaged stock market returns for various countries, Europe and Pacific and France and Germany and Brazil and Russia, and you're going to see that a lot of them are double digits. But I'm just going to tell you that Europe is very sick from an economy point of view. This graph right there and that which I've circled, you're going to see that in the last 2-3 years or so, we've had a declining year-over-year percentage return on the GDP for Europe, as just one example. You're going to see there on the right-hand side that unemployment is in the double digits for Europe. So the economy does not necessarily mean that the market is going to go down if the economy goes down. It is definitely a headwind, and I'd rather have it as a tailwind, something to help. But if all other things, the amount of cash that's in the economy, if other factors are pushing things so that the investments are going up, then the economy might be holding it down a little bit, but it doesn't mean that perhaps there's so much momentum on the investing side that it overcomes any impact that other factors might have on it. So it's not just that, oh, this is the negative. Well, wait a second, there's some positives as well. And the question is, how does it net out? And so some people might say the headwind from a bad economy or something that the government might do is going to negate all of the amount of cash that we've built up, all the balance sheets that are in corporations, and all the innovation that's going on right now. I'm just not in that particular camp. Another thing you're going to hear an awful lot about is the Fed. We have a new nominee. Her name is Yellen. They're going to call her the Dove because she will very likely keep a very loose monetary policy, meaning there's going to be lots of cash available for loaning, and it's just very accommodating towards that. The economy does have a tendency to slow down or muddle through. My guess would be that she's going to maintain that low interest rate and maybe even increase some of those bond purchases. We'll have to see, but I think our loose monetary policy is going to continue. Interest rate yields have been increasing significantly in the last months. And here's a graph here showing over the last, 20, 30 years or so, even longer than that. And you can see that they've really gone down during that time frame. And yes, in the last 2, 3, 4, 5 months, it has increased. However, just because the yield on the 10-year right now is around 2.64, 2.65, it's not until it gets around 5% historically that has really caused a negative impact to the degree that while it's continuing to increase, the market is going down. And you'll see that on this graph right here, there's a lot of numbers there, but essentially what you're seeing there is that dotted line right there in the middle is the 5% mark. And as the interest rates continue to go up, the yields, the unmanaged stock market indexes went up as well. And so only once it hit over 5%, did it cause such a drag on the available capital for investment and for improvements that it started to hurt the U.S. stock market. We're still far from that at 264, give or take. That's what it is as of Thursday when I'm doing this video. Another thing that I want to talk about is you're going to hear about consumer confidence, and that consumer confidence is up or is falling, or etc. And I put no credence on consumer confidence. So I'm putting that chart up there, and you're going to see that sometimes when consumer confidence is at its low is when you would have liked to have invested 100%. Sometimes when it's high, it's a lagging indicator. People feel real good about things. And by the way, the University of Michigan only surveys 300 to 500 people on one day over the month. So it's not a very big statistical sample, in my opinion, and I put no I don't care. I don't care about the consumer confidence, and hopefully you don't care as well. You're going to see right here on this next graph that the way people are feeling good right now is because we've got a little bit of a housing bump up in the last 2-3 years or so, and that is one more proof that interest rates are probably going to remain very low because we have a housing recovery. People are feeling really good and have a hard time seeing how they're going to increase the rates from the Fed in a very short time frame. And so that and the fact that we have so much federal debt out there that we have to finance, we've got to keep the rates at a very low rate. So I do believe that that's probably going to stay low. I do think that it's very reasonable for companies to have accumulated corporate cash over the last 2, 3, or 4 years. Right here on this next graph, you're going to see deploying corporate cash. It's at very high levels. Companies have been very, very rational in keeping their cash ready to invest when it makes sense. And this is a good thing. And cash returned to shareholders is also at a very high level, the amount of dividends that have been paid out. So there's a lot of cash out there for those investors on the sidelines ready to jump in. You're going to hear a little bit about PE ratios and other things. Right now, I'm not concerned that it's too low or too high. I think it's going to be just fine. This graph right up there, you're going to see that when that dotted line from top to bottom there, many times when it's at this level, the returns for the stock market indexes have been positive. Sometimes they've been negative. You can see that, but a large preponderance of them have been up on the top side. Only when it gets up to a 20 and 30 time does it really, really get way out of whack. The next thing I want to talk about is that I do believe that Warren Buffett has been talking about the U.S. debt as a percentage of our GDP, which is really our national income for the country, is not concerning to him. And right now it's at about 102, 104%. And I do think that long term it provides a headwind against the investing and the ability of that particular country in order to move forward, because it's, of course, sucking out available capital to finance that particular debt. You're going to see here on this graph that I've just put up there that the U.S. is kind of on the right-hand side of that 100 mark. And you'll see that as you go down, Greece and Portugal and some other countries that are really an absolute mess, as their debt got bigger and bigger and bigger. It's not by the size, by the way. That's what the yield is. The yield comes after some of the problems. So for right now, just really look at how the U.S. is on the right-hand side of that vertical line, which is not the side that we really want to be on. At this point, I do want to start summarizing, which is time is your friend. This graph right up there, you're going to see is a depiction there. The green is the range over the last 52, 53 years of the unmanaged stock market index. Is very high, very low. Bonds, high and low. And then we have a 50-50 match of the two. What you've seen is on an annualized basis, when you get out to 5 years, 10 years, and even 20 years, you have a normalizing returns, but you're also seeing that the they have a tendency, and historically have been, and that's all that we have to go on. The future could be different, but historically what has happened is that those returns, those people who have been patient for 5 years, 10 years, and 20 years have had positive returns or even break even. There's not been many opportunities over a very long time frame for there to be a decline. One of the frustrating things is with this low interest rate environment, the options are very low, or very few, I should say. CDs and your money markets are hardly paying anything. Bonds have a very low yield at this point, and so unfortunately many of us have been moved towards higher risks that we might not otherwise have taken. I'm coming to a conclusion here. The last chart I want to show is right up there on the screen. It is the annual returns. It is normal for there to be declines throughout the year. And this year, believe it or not, has had from a top to a bottom an unusually low top to bottom drawdown. It has either been more up or sideways this year, not a lot of huge declines on the downside. It does not mean that when there's a drawdown throughout the year that the year will end negative or that everything is just going to heck. And so this graph is very important because we as investors who are in it for the long term, who have hopefully created a portfolio that's consistent with our risk levels and our objectives, etc., we have to understand that there will be some volatility in the market. And if we can't handle that, then we have to really seriously evaluate the strategy that you have. That is what I have here today. Please give me a call if there are any concerns whatsoever. I can talk your ear off about some of my thoughts as we go forward and strategies that we should have or could have. Mike Brady, Generosity Wealth Management, 303-747-6455. You have a wonderful day. Thanks. Bye-bye.